What's happening, everybody? It's your boy Kreative. Go ahead, say it with me. We are back at it again to do what? To create something great. Now, today I'm super excited what I have planned for y'all. We are going to be dropping another episode in our KreativeU series, and we're going to be going over the option terminologies that you're probably hearing when you're watching CSNBC, when you're reading the Financial Times, or maybe even The Economist, right? So I want us to be able to get a little bit more breadth and depth as to what those terms are, so we can be a little bit more informed when we're trading options. Now, here at KreativeU, what our aim is to be able to drop different episodes, right, where we're breaking down algo trading strategies, where we're breaking down AI agents and what makes them tick and work, and understanding the different levels of machine learning. So today we're going to be going over options, and if you haven't already, I need you to go ahead and like and subscribe. So let's go ahead and jump on into it. So with 100 shares, we can control 100 shares just with $500. Guess what that's called? That's called leverage, right? Options sound complicated, but they're just contracts, right? We mastered the Greeks, we understand the game. So, what is an option? An option is a contract that gives us the right, but not the obligation. So, it gives us the right, not the obligation, right, in order to buy or sell an option, a stock, excuse me. Buy or sell a stock at a specific price. That specific price is going to be our strike price before a specific date. That specific date is going to be our expiration date. Key term here is to you have the right but not the obligation, right? And you can let it expire worthless, but that's bad, depending on how you do it. Right. So think of an option like a concert ticket. We pay $50 for the ticket. That is the premium. The ticket is for Friday night. That is the expiration date. This gives you the right to see the show. Now, if you don't go, we just lose the $50, right? That's it. You can't afford to lose more than the ticket. That's how options work the same way. So, pro tip, our max loss is going to be the premium that we paid up front. Unlike shorting options, we can't lose more than we invest. Reality check, but premiums can go to zero real quick. So if an option expires worthless, you'd lose 100% of the premium you paid. You got it? Beautiful. Let's keep going. So for calls and puts, so call options are we're bullish on the markets. What do bulls have? Bulls have horns, and what do horns do? Those horns point up. So when we buy a call, we're bullish on the market. This is our right to buy a stock because we profit when the price goes up. So we're bullish on the market. We think that the market is going to go up, right? When we buy a put option, we're bearish on the market. What do bears palms? Bears palms are down, right? You bear down. This is the right to sell a stock, and we profit when the market or the price goes down. So a real example is we have a SPYs at 696.61. We buy a a $700. This is our strike price. A call option is our right. We're bullish on the market for 285, not $285, because for every one option contract there's 100 shares. So we paid $285. We want SPY to go above 700. So if SPY goes to 710, the option is now worth $1,000. Our profit is $715, right? If SPY stays at 695, our option becomes worthless and we just lost what we paid. So for puts, it's the inverse. SPY is at 696. We bought a put, a 690 put. So the 690 is going to be our strike price. The put is going to be the right to sell, and we're bearish on the market. We're going to be buying that put for $250 or $250. Remember, we're going to take our premium, multiply the number of shares because there's 100 shares in one option contract, and we paid a total of $250. So we want SPY to go below 690. If SPY goes to 680, our option contract is approximately worth $1,000. We just made $750, right? But if SPY stays at 695, the option goes worthless and we only lose what we paid, which is the premium. Pro tip here, our calls, we're betting that the option or the market goes up. Puts, we're betting that the market goes down. Both can make money. Pick based on your market view. Reality check, 75% of options expire worthless. 75% of them. That means only a quarter of people are making money. That's crazy. So what the thing about algo trading? Buyers lose more often than they win, so we have to be super selective. 75%. That's high, fam. So 3 key numbers for every option. So the strike price is going to be the target price. This is the price at which you want to buy or sell the stock. Remember our example previously, our $700 strike is we have the right to buy SPY at $700, or the put, we have the right to sell it at $690. Our expiration date is when the option contract becomes worthless. I don't want to say that. All right, every option has a deadline, weekly, monthly, or 0 DTE, same day options. So weeklies are going to be option contracts that expire on Friday. Monthlies are going to be option contract that expire on the last Friday of the month. And 0 DTE options, option contracts that I love, are going to be option contracts that expire the same day. So why wait a week, 5 weeks maybe, or you get paid the same day? Again, this is not investment advice. If you do seek investment or financial advice, please make sure you talk to a financial certified planner, a financial advisor, or those that are licensed in order to assist you with your questions. This is merely educational, fam. Premium is what you pay up front. So this is the cost for the option. So the premium is going to time a premium times 100, because there's 100 shares in one option. That's going to equal your total cost. So 295 equals a premium of 285, right? This is your max loss if the option goes worthless. So critical thing to note is that one contract equals 100 shares. So the premium is going to be 285 per share. So the actual cost is 285. So we control 100 shares, right? For 285 bucks, right? Or we can go pay per share. So that's why it's a little bit easier to be able to trade options, right? Because we can control more shares for less amount of money. But again, this gives us the right to buy it. You still got to go buy it. So this is what you're buying here is just the option for the right to go buy, because you still have to go buy it, gang. All right, we got it? Perfect. Always multiply the premium by 100 for the real cost. Beginners forget to do this and are shocked, at checkout. Reality checks, option notations are SPY 1217 700C. So SPY is the S&P 500, the top 500 companies within the New York Stock Exchange. 1227 is going to be the expiration date. This is the last date that the option or becomes worthless, right? And 700C is going to be our right or our strike price. 700 is going to be our strike price. C is going to be our right. Got it? Beautiful. All right, let's go to the next item, and it's going to be, where is the strike relative to the stock price? This is going to be moneyness, right? So the current price of SPY, the S&P 500, is 696.61. In the money means that option contracts that are already profitable. If you already profitable, these are going to be option contracts that are going to be one of the most expensive ones. The ones that are ITM or in the money. Calls that are in the money is the strike price is less than the stock price. So call of 690 is when SPY is 695, is $5 in the money. A put in the money is when the strike price is greater than the stock price. So a put of 700, call is at 695. We have in the money of $5. More expensive, safer, moves more with the stock. So this is like almost a one-on-one move with the stock, and that'll make sense a little bit later. So let's keep going. At the money is going to be the strike price is almost equal to the stock price, right? So an example would be a 695 call when SPY is at 695. More liquid, best for trading, balanced risk reward, but highest time value. Theta decay hurts the most here. And theta decay is how much money that we're losing each day, each minute, each hour for being able just to hold the option. And OTM is going to be option contracts that are out of the money, so not profitable yet. So a call OTM is going to be a strike price that is greater than the stock price. So call of 700 when SPY is at 695, $5 OTM of $5 out of the range, right? And then a put OTM is when the strike price is less than the stock price. 690 put, but your call stock price is 695, and we have a $5 OTM for our put. So it's cheaper, it's riskier. These are kind of considered lottery tickets. Can go up 10x or go down to $0, the same effect. Pro tip, OTM options need big moves to profit. ITM options almost one-to-one with the stock, higher delta. And delta is going to be the probability of profit, or for one dollar move, positive or negative, right? That's how much your option contract is going to gain. So reality check, most 0DTE traders buy OTM options, cheaper lottery tickets, 90% of them expire worthless. So before we had a stat that 75% of all option contracts expire worthless. Now, if you buy OTM, that is 90% gain. So of the 75%, 90% of them are OTM. Oh, that's crazy. Crazy. You actually do the numbers. So now let's talk about the intrinsic and extrinsic value, right? What makes an option premium? So the premium equals the intrinsic plus the extrinsic value. The intrinsic value is the real profit if we exercise it right now. So a stock price, for a call is going to be the stock price minus the strike price. And then for a put, it's going to be the strike price. So you just flip it, the strike price minus the stock price. If OTM intrinsic is always going to be 0, right? Only ITM options have intrinsic value. OTM doesn't. That's all hopes, dreams, and speculation. That's all extrinsic values, right? That is going to be time value plus volatility value, also called time value, right? More time until expiration, more extrinsic value, higher volatility, more extrinsic value. Decays to 0 by expiration, theta at work. So here's an example, is that we have a 690 call and the current call is at 696. So this is OTM. So our premium paid, no, this is ATM. This is no ITM. This is ITM. ITM contract because it's $6 up. So that's fine. This is ITM, not OTM, excuse me. So we paid $850. Of that $850, our extrinsic value is going to be the stock price, which is $696, minus the strike price, which is $690. And then we have $596, and this is just the intrinsic value. So if we were to sell it right now, this is how much money we would get right now. If we were to, that's crazy, right? And then extrinsic is going to be $281, the difference left over. That is going to be time value plus volatility. As expiration approaches, the intrinsic value stays the same, real value. The extrinsic value decays to 0. Theta eats it, right? Pro tip, ATM options equal 100% extrinsic value. That's why we lose value fast from time decay. Reality check, 0DTE expiration dates. Extrinsic value vanish fast, only intrinsic remain. All right, now let's talk about our Greeks. So how much does an option move when the stock moves $1? This is going to be delta. So delta is going to be the rate of change for the option price versus the stock price. And delta also tells us the probability of profit. More on that in a bit. So a delta of 0.5 means that for every $1 move, the option contract is going to move $50 or 0.5. If the stock moves up $10, and then the option contract now is gained 500, right? Because there's, for every one option contract, there's 100 shares. So delta ranges for calls from 0 to 0.1, and then for puts from -1 to 0.0. So delta by moneyness, ITM is going to be approximately from 0.7 to 0.95, almost like the stock, right? The closer you get to 1, the closer you are for stock movement or dollar for dollar movement. ATM is going to be approximately 0.5. So this is a 50-50 chance of profit. Remember I told you probability of profit. And then OTM is going to be approximately starting at 0.5 and 0.35. So for ITM options, you have a 70% chance or 95% chance of being able to expire in the money, meaning that you will probably make money with this, but it's going to cost the most. ATM is going to be a 50% chance of profit. And then for OTM is going to be a 5% or 35% chance that you're going to profit. So here are live examples of ITM, ATM, and OTM. Pro tip is that delta also, I told you that. Yeah, I told you that, so I'm not going to repeat that. I know what I'm talking about too, bruh. So we have theta. Theta is the silent killer. This is time decay. So theta is how much value your option loses per day. So theta of negative 0.05 means that every day your option loses $25. And that's $25 per contract, even if the stock doesn't move. Time is not your friend as an option buyer. So time decay acceleration, 30 days out, it's 10. 7 days out, it's $35 a day. And then 1 day out, you're losing $120 a day. Zero DTE, you damn near could lose $300 a day. But again, if you do this right, you can print money too. But again, not financial advice. If you do seek financial advice, please make sure you talk to a certified financial planner, those that are licensed that can assist you with your financial questions. This is merely educational, big bruh. All right, let's keep going. 7-day option. We have our premium that's at $520. Theta is at $35 a day that we're losing. Premium, damn, that's crazy. Zero DTE, right? You paid $150, but you're losing $120 a day. That's crazy. Zero DTE are 3.4 times faster. ATM options have the highest theta decay. That's why they're more sensitive to time passing. Reality check for zero DTE, the last hour are brutal. I don't know why you would trade the last hour, but you can print money, but I don't know why you would trade that. So gamma, secondary options, but still important. I don't want to call gamma secondary options depending on how you use it, but it really is still important. Vega is going to be the sensitivity to the implied volatility, or IV. So Vega of 0.5 means that if IV goes up 1%, the option price goes up $15. If IV goes down 1%, the option price goes down $15. High Vega equals more sensitivity to the volatility changes. ATM options have the highest Vega. Why Vega matters: earning announcements, IV spikes, options get more expensive. After earnings, IV crashes. That's called the IV crush. Option value loses. Calm market, low IV, cheaper options. Now, gamma, I really wouldn't call this a secondary option, but hey, it's depending on how you use it. Gamma is the rate of change of delta. So if delta is telling you, delta is the car, gamma is the pedal, right? So the car will move, but gamma is going to tell you how fast it's going to move. So if gamma of 0.02 means that the stock moves $1, delta changes by 0.02. High gamma equals delta changes fast as stock moves. ATM options have the highest gamma, but zero DTE have extreme gamma. Why gamma matters: high gamma equals option values can explode with little stock moves. Zero DTE have extreme gamma. That means you can gain or lose, losses accelerate. ATM zero DTE can go 5 to 10x in minutes just from gamma. Pro tip: Vega is the highest far from the expiration. Gamma is the highest closest to expiration, especially for zero DTE. Reality check: high gamma, high risk both ways. Gamma can wipe you out as fast as it can make you rich. Big facts, bruh. And then we're going to talk about implied volatility. Implied volatility is going to be the market expectations for future movement. IV equals the market prediction on how much the stock will move. Low IV is going to be anywhere between 10 and 15%. The market expects small moves. It's very calm. Medium IV is going to be anywhere between 15 and 25%. There's normal volatility, so not that much is shaken. And then high IV is going to be 25+%. Market expects a big move, so chaos is coming. Higher IV, the more expensive the contract. So why same strikes have different prices? It's all because of the IV. A calm day of 12% IV stock, this 700 call could cost you $250. But that same 700 call, if you have high IV on earnings day, $680, bro, almost $300 more for the same option, right? Same strike, same expiration, 2.7 price difference because of IV. Now, IV crushes when IV suddenly drops after the event. This is commonly happens after earning reports, the Fed announcement, or any major news. Your option loses 30 to 50% value instantly, even if you pick the right way. That's why don't trade these events, bro. All right, now let's talk about zero DTE. My lane, my gang. Zero DTE are going to be option contracts that expire the same day. So zero DTE, 0 days to expiration, same day options. So option contracts that expire today, bought and sold on the same day, expire worthless at 4 p.m. EST if OTM. extreme leverage, extreme risk. Can go 10x in minutes or to 0. Why 0 DTE is different? Theta decay is brutal, right? We can lose hundreds of dollars per hour just with theta. Gamma is extreme, explode with small moves. That's where you could probably print your money. So that's why I don't consider gamma to be a secondary Greek. But hey, let's keep going. Vega is not that much. You don't really care that much about Vega. You can use it, but you really don't care that much about Vega when it comes to 0 DTE. You're looking at gamma, delta, theta, depending on how you risk manage. So you're primarily looking at delta and gamma, and theta is depending on how you risk manage. So the life cycle for 0 DTE at 9:30, as soon as the market opens, you have high premium, lots of time. At noon, you probably want to stop trading by then, but hey, at noon, premium is going to start dropping. Theta is eating value. 2 p.m., the last 2 hours, theta is accelerating. The final hour of 0 DTE are collapsing fast, right? And at 3:59, 0 DTE goes to $1.01. Only intrinsic value. The market closes, all 0 DTE options expire. A typical trade. So at 695, we buy SPY's at 695. We bought a 697 call for $50. The market moves to 698. The option is now worth $250. That's a $200 gain. Or SPY stays at 695 for 2 hours. Option decays to 0.05, 90% loss, and that's $45. Pro tip: 0 DTE is not investing; it is pure speculation. I don't agree with that. Only risk what you can afford to lose completely. Reality check: 95% of 0 DTE options expire worthless. It is a zero-sum game when where most players lose. Trade tiny sizes. But again, it's all depending on how you trade. That's probably hand traders. I don't know. I want to see the stat for algo traders. And here's a look at option chains today, right? And today, this is a little bit after the market. It is 5 p.m. But we're looking at a live option chain for SPY, and SPY is the S&P 500, the top 500 companies within the New York Stock Exchange. And we are pulling data from Thinkorswim or Schwab, right? And again, this is after hours, so that's why it's going to say the API is limited. And if you look at the strike prices here, we see the premium, we see the delta. Look at theta, IV is not that bad, and then we have our bid and ask price, and then we have ATM is down here. That's crazy. 120, fam. Kind of crazy. So what we see here. So this is everything that we've gone over today, right? We being able to understand what options are, being able to go through calls and puts, contract basis, moneyness explained, the intrinsic values, and our Greeks and 0 DTEs. Now, if you want more videos like this, I need you to go ahead and like and subscribe. It is your boy Kreative. I will be back at it again with another episode. I appreciate you.